Hello and welcome back today. Silver investors wake up to carnage. The price has collapsed roughly 30% overnight, the steepest one-day fall since 1980, 46 years ago. But this isn't just a price crash. It's a systematic dismantling of leveraged positions across global markets, margin calls forcing liquidations, brokers raising maintenance requirements mid-crisis, liquidity evaporating as bids disappear. And for Hong Kong investors, the HKD pegged to the dollar, transmitting every shock directly into local quotes. What started as news about Kevin Warsh potentially becoming Fed chair turned into a cascade of forced selling that revealed just how fragile modern precious metals markets have become. This is the story of how a normal pullback became a 30% catastrophe, how margin mechanics amplified a 5% dollar move into a metals apocalypse, and why Hong Kong investors, caught between dollar strength and broker risk controls, faced a uniquely brutal day. Today we're exposing the margin call death spiral, revealing how HKD peg magnifies USD shocks, breaking down what forced selling in crowded trades actually looks like, and providing a practical survival guide for the volatility that's now the new normal. NAR. The 46-year record, silver's worst day. Since 1980, let's start with the magnitude, a 30% single-day collapse, the steepest fall since 1980. 1980 is significant. That was the year silver hit its all-time high of $50 per ounce during the Hunt brothers' attempt to corner the market. When that manipulation collapsed, silver experienced catastrophic declines. Nothing since 1980. Not the 2008 financial crisis, not the 2011 silver crash, not the COVID panic, has produced a single-day decline this severe. Until January 31st, 2026. This isn't just another correction. It's a once-in-a-generation event that will be studied in finance courses for decades. But here's what makes this different from 1980. The 1980 crash was the collapse of a manipulation scheme. The 2026 crash is the unraveling of a legitimate investment thesis overwhelmed by leverage and forced selling. The Hunt brothers were actively trying to manipulate prices. Modern silver investors were simply betting on dollar weakness and inflation hedging. Both crashed spectacularly. But the 2026 version reveals more about market structure vulnerabilities than manipulation. It shows that even without malicious actors, excessive leverage and crowded trades can create market failures. The Warsh catalyst. Policy continuity kills the hedge demand. The trigger was straightforward. Reports that Kevin Warsh could lead the Federal Reserve. But the mechanism was subtle. The article notes that markets read the chatter as policy continuity, which cut demand for hedges. Let's unpack that. For months, the precious metals rally was driven by hedging demand, investors buying silver and gold as insurance against dollar debasement, Fed policy mistakes, inflation resurgence, geopolitical chaos. The Warsh news changed the calculus. If Warsh becomes Fed chair, that signals hawkish monetary policy, inflation fighting as priority, dollar strength, policy credibility. Suddenly, the need for hedges diminishes. If the Fed will fight inflation credibly, you don't need gold and silver as insurance. This killed the fundamental investment thesis underlying the rally. Not slowly, over weeks, instantly. The article notes this triggered broad selling and volatility. That's understated. It triggered a panic. When the core reason for owning an asset disappears overnight and everyone is positioned the same way, the exit gets violent. The dollar surge. Fast and leveraged. A fast dollar surge hit leveraged long positions. This sentence contains the entire explanation for the 30% crash. The dollar didn't rally 30%. It moved a fraction of that, maybe 1% at most in the initial spike. So how does a 1% dollar move create a 30% silver crash? Leverage amplification. Silver futures allow 20.1, 50.1, even 100.1 leverage on some platforms. Let's walk through the math. Scenario. You buy $100,000 worth of silver using 20.1 leverage. You post $5,000 margin. Dollar rallies. Percent. Well, silver typically moves inversely to the dollar, so silver falls roughly 2%. Metals are more volatile than currencies. Your position. A 2% decline on $100,000 is a $2,000 loss. You've lost 40% of your $5,000 margin. Broker action. Your margin has fallen below maintenance requirements. You get a margin call, post more cash, or we liquidate your position. You can't or won't post more. Your position gets automatically sold at current market prices. Now multiply this by thousands of traders simultaneously. Each liquidation adds selling pressure, driving prices lower, triggering more margin calls, causing more liquidations. This is the margin call death spiral. And it's exactly what happened January 31st. Brokers raising maintenance requirements, adding fuel to the fire. Here's where it gets worse. Brokers raised maintenance requirements. During normal markets, you might need to maintain 25% margin. During volatile markets, brokers can and do raise this to 40%, 50%, or higher. They do this to protect themselves. Higher volatility means higher risk of customer accounts going negative. Brokers don't want to be left holding losses if customers can't pay. But the timing is brutal. Right when prices are falling and traders are already under pressure, brokers raise the collateral requirements. This forces even more liquidation. Traders who had adequate margin at 25% requirement suddenly don't at 40% requirement. More positions get forcibly closed. The article notes this clearly. Margin calls forced positions to close, adding to the drop. It's not optional selling. It's not taking profits. It's forced liquidation. Selling at whatever price is available because the broker's system is automatically closing positions. And when thousands of positions are being force closed simultaneously, prices gap violently. Systematic strategies, when algorithms amplify crashes. Many systematic strategies reduce risk when volatility rises, which can amplify moves. This is referring to algorithmic trading systems that automatically adjust positions based on volatility metrics. Here's how these systems typically work. Normal volatility. The algorithm allocates 10% of the portfolio to silver. Volatility spikes to 2x normal. The algorithm automatically cuts allocation to 5%. Volatility spikes to 5x normal. The algorithm cuts allocation to 2% or exits entirely. This is programmed risk management. It's supposed to protect the fund from catastrophic losses. But when hundreds of these systems trigger simultaneously, they amplify the crash. As volatility rose January 31st, systematic strategies across hedge funds, CTAs, commodity trading advisors, and algorithmic funds all started reducing silver exposure. This created waves of selling that had nothing to do with human decision-making. It was pure algorithmic response to volatility. The systems are designed to sell when volatility spikes. Volatility spiked. They sold. Their selling caused more volatility, which triggered more selling. It's another feedback loop. And unlike human traders who might pause and reassess, algorithms execute instantly and mechanically. Not liquidity evaporation, when bids disappear. Liquidity thinned as bids stepped back. This is the final piece that turned a 10% correction into a 30% catastrophe. Market makers and professional traders provide liquidity by constantly quoting buy and sell prices. They make money on the bid-ask spread. But when volatility becomes extreme, market makers pull back. The risk of getting caught on the wrong side of a massive move outweighs the profit from spreads. So they step back. They widen their spreads. They reduce the size they're willing to quote. What happens when liquidity disappears? Small orders create large price moves. A $1 million sell order that would normally move silver, $0.50, now moves at $5. Stop-loss orders hit air pockets. Traders with stops at $100 might get filled at $95 if there are no bids in between. Panic intensifies. When traders see prices gapping violently, panic increases, causing more selling into the liquidity void. The article calls this a cascade of forced selling and sharp intraday swings. That's exactly right. Without market makers providing bids, every wave of forced selling from margin calls created gaps and air pockets where prices simply fell with no support. The gold spillover, Cross-asset contagion. Selling extended to gold as investors trimmed metals exposure to meet margin and manage risk. This explains why gold also crashed even though silver was the primary focus. Many investors and funds don't just hold silver, they hold both silver and gold, often in fixed ratios or as part of broader precious metals allocations. When silver started collapsing and margin calls hit, traders needed to raise cash. How do you raise cash quickly? Sell your liquid assets. Gold is extremely liquid. Even if your gold position was profitable, even if gold wasn't experiencing the same fundamental pressure as silver, you sell it to meet margin calls on silver. The article notes, cross-asset funds often balance positions across silver and gold, so stress in one can spill over to the other. This is contagion. Silver's crisis became gold's crisis not because of shared fundamentals, but because of shared ownership and leverage. It's a reminder that diversification works in normal markets but breaks down during extreme stress. When correlations go to 1.0, everything moves together. Jarwao, the Hong Kong impact. HKD peg transmits every shock now. Let's focus on Hong Kong specifically because HK investors faced unique challenges. The Hong Kong dollar is pegged to the US dollar at approximately 780 HKD USD. This peg is maintained strictly by the Hong Kong Monetary Authority. What does this mean for precious metals? Dollar strength flows directly into local quotes. When the USD rallies, silver priced in HKD falls by the same percentage. There's no currency buffer. Faster local price declines. When the USD jumps, the silver price in HKD can fall faster if global buyers step back. Hong Kong investors don't get the cushion that, say, European investors get from euro-dollar exchange rate fluctuations. Every dollar move hits HKD-quoted silver immediately. This makes Hong Kong particularly vulnerable during dollar spikes like January 31st. Wider spreads. The Hong Kong execution problem. Banks and dealers may widen spreads during fast markets. This is a critical point for Hong Kong retail investors. During normal markets, you might see a 1 to 2% spread between buy and sell prices for silver. During extreme volatility, that can widen to 5 to 10% or more. What does this mean? If the spot silver price is $85, a dealer might quote, normal market. Buy at $86, sell at $84, 2% spread. Volatile market. Buy at $90, sell at $80, 10% spread. You're immediately down 10% just from the spread if you buy and immediately need to sell. For Hong Kong investors trying to navigate January 31st, this meant executions far worse than expected, large slippage on orders, difficulty getting firm quotes, rapidly changing prices between quote and execution. The article warns, local investors should expect more volatility and overnight pricing that carries into the Hong Kong morning session. This is crucial. Hong Kong is closed when New York is most active. The massive moves happen overnight from an HK perspective. Hong Kong investors wake up to find silver has already crashed 20% before they could react. Broker risk controls. Faster liquidation in Hong Kong. During extreme moves, brokers often tighten risk controls. Hong Kong investors faced higher initial margin. If you needed $5,000 to open a position yesterday, you might need $10,000 today. Reduced leverage. Your 21 leverage gets cut to 10-1 or 5-1 overnight. Stricter stop-out rules. The price level at which your position gets automatically closed moves closer to current price. Faster liquidation. Risk. HK investors using margin face faster liquidation risk when prices gap. This last point is critical. During the Asian session, if silver gaps down sharply and your position hits the liquidation threshold, there might not be enough liquidity to close your position at a reasonable price. You could face catastrophic slippage, getting stopped out 10-20% worse than your actual stop level because there were no bids available. The article's advice, keeping extra collateral in HKD can reduce forced selling and avoid slippage during thin liquidity hours. This is practical wisdom. Having excess margin means you don't get auto-liquidated during a gap. You survive to make rational decisions rather than getting forced out at the worst possible prices. The physical premium problem. Premiums on popular bars and coins can widen if wholesale supply lags. This creates a paradox for Hong Kong physical silver buyers. Paper silver crashes, 30%. Futures and spot prices plunge from $110 to $77. Physical premiums widen. Dealers might charge $85.90 for actual bars and coins even as paper prices show $77. Why? Because wholesale supply takes time to adjust. Dealers protect themselves against further volatility. Retail buying often increases during crashes, people trying to buy the dip. Minting and shipping capacity can't instantly match demand. The article warns, for larger tickets, request firm quotes before funding, since quotes can change quickly. This is essential in Hong Kong's market. Don't assume the online quote is the price you'll actually pay. Call the dealer, get a firm quote, lock it in, then fund. And verify delivery timelines. If paper silver is at $77 but you can't get physical delivered for 6 weeks and premiums are $10, you're really paying $87. Technical levels. What Hong Kong traders should watch. The article provides specific technical guidance. Watch prior multi-month support on daily charts. Look for where silver previously found buyers. Those levels often act as support again. 200-day moving average. This is a widely watched medium-term trend indicator. If silver stabilizes above it, that's bullish. Below it, bearish. Volume patterns. If price stabilizes above those areas on rising volume, it can signal repair. Rising volume at support suggests real buyers are stepping in. Low volume bounces often fail. Breakout zones. Areas where silver previously broke to new highs often become support on the way back down. For Hong Kong traders specifically, the article warns, Asia hours can be quieter, so shocks from New York often echo into early Hong Kong trade. This means, don't assume opening prices will hold. The first hour of HK trading can see continued volatility from NY overnight moves. Use limit orders, not market orders. Check order book depth before placing large orders. The Practical Playbook, Survival Guide for Volatile Markets. The article provides an exceptionally practical framework for Hong Kong investors navigating this volatility. Position sizing. Size positions for worst-case swings, not average days. If silver can fall 30% in a day, your position size should be able to survive that without forcing you to liquidate. Predefine stops. Predefine stop levels and use alerts. Know before you enter exactly where you'll exit if things go wrong. Don't make that decision during panic. Partial hedges. Consider partial hedges with inverse products or reducing gross exposure when volatility spikes. In Hong Kong, this might mean buying inverse ETFs or reducing position size when realized volatility exceeds normal levels. Never add to losers during crashes. Avoid adding to losing trades during fast drops. This is critical. The instinct to average down during a 30% crash can destroy your account if the crash continues to 40% or 50%. Cash buffer. Keep a cash buffer in HKD to meet margin if needed. As we've discussed, having excess collateral prevents forced liquidation during gaps. Overnight risk management. Review overnight risk so gaps do not exceed planned loss limits. For HK investors, this is existential. The biggest moves happen while you sleep. Your position size must account for that. Diversification reality. Gold correlations in stress. Gold price can diversify a silver-heavy portfolio, but correlations rise in stress. This is a sophisticated point that many investors miss. Normal markets. Gold and silver don't move in lockstep. Sometimes silver rises while gold falls, or vice versa. The correlation might be 0.6 or 0.7. Stress markets. Both metals move together. The correlation approaches 1.0. January 31st demonstrated this perfectly. Silver crashed 30%, gold fell nearly 10%. Both moved in the same direction. The article's advice: use staggered entries rather than a single buy, scale in small tranches, and wait for basing patterns. This means don't buy all at once trying to catch the bottom. Buy 20% of your intended position. Wait for signs of stabilization. Higher lows, reduced volatility. Buy another 20%. Repeat. This way, if you're early and silver falls another 20%, you haven't committed all your capital at the wrong level. Yaurer. What to monitor. The Hong Kong Investors Watch List. The article provides a clear monitoring framework. Macro catalysts. Official confirmation or rejection of Warsh nomination, fresh U.S. jobs and inflation data, signals on real yields up, real gold, silver down. Position data. ETF flows. Are investors buying or selling precious metals ETFs? CFTC positioning. Are speculators net long or short? Dealer inventories, building or depleting? Local HK factors. Broker margin circulars. Are requirements being raised or lowered? Changes in local trading hours. Spread policy changes that affect execution. This last category is uniquely important for HK investors. Your local broker's policies matter as much as global price moves when you're operating in a pegged currency environment. Warsh. The risk-first mentality. The article's concluding framework is worth highlighting. Focus on risk first. Reduce position size, use limits, and keep cash for collateral. This is the opposite of how most retail investors operate. Most retail investors focus on 1. Where's the bottom? 2. How much can I make? 3. Am I missing the bounce? The article correctly inverts this. 1. How much can I lose? 2. Can I survive the worst case? 3. Do I have enough cash for margin? This risk-first mentality is what separates survivors from casualties in 30% crash days. Stabilization signals to watch. Reclaiming broken supports, falling volatility, narrower bid-ask spreads. Only after these signals appear should you scale in. The article's final wisdom. A measured, rules-based approach beats trying to catch every bounce. This is profound. The temptation during a 30% crash is to try to catch the exact bottom. If I buy at $77 and it bounces to $90, that's a 17% gain. But if you buy at $77 and it falls to $60, you're down 22% and likely getting margin called. The rules-based approach says, wait for confirmation of stabilization, accept that you'll miss the first 10% of the recovery, but dramatically reduce the risk of catching a falling knife. The Hong Kong-specific edge. Hong Kong investors have unique advantages that the article implicitly acknowledges. Access to Asian session. While U.S. investors sleep, HK investors can react to Asian developments and position ahead of NY Open. Dual market access. Hong Kong investors can trade both local HK products and international platforms, providing optionality. Physical market knowledge. Hong Kong has deep physical precious metals markets. Understanding local dealer dynamics provides edge. Currency awareness. The HKD peg means HK investors must think in dollar terms naturally, while U.S. investors often ignore currency effects. But these advantages only matter if you survive the volatility, and surviving requires the discipline the article outlines. The bottom line. January 31st saw silver collapse 30%, the steepest one-day fall since 1980. The Warsh Fed chair news triggered a cascade. Dollar strength, leverage hitting long positions, margin calls forcing liquidations, brokers raising requirements, systematic strategies reducing risk, liquidity evaporating, forced selling amplifying, gold contagion spreading. For Hong Kong investors, the HKD peg transmitted every dollar shock directly. Brokers tightened controls. Spreads widened. Overnight gaps created liquidation risk. Physical premiums diverged from paper prices. The crash revealed that excessive leverage, crowded trades, and thin liquidity turned normal pullbacks into catastrophes. The survival playbook: size for worst case, predefined stops, keep cash buffers, use limits, not market orders, scale in gradually. Wait for stabilization signals, monitor broker margin policies, track overnight risk. Risk first beats return chasing, rules-based beats bottom calling, survival beats heroics. January 31st won't be the last 30% crash. Market structure guarantees more volatility ahead. The investors who survive will be those who learned from this day and adjusted their approach accordingly. For Hong Kong investors specifically, your peg makes you vulnerable to dollar moves, but your access to Asian sessions and physical markets provides opportunities if you manage risk religiously. The 30% crash was a reminder. In leveraged markets, margin calls don't care about your long-term thesis. They only care about your collateral today. If this Hong Kong-specific analysis helped you, hit that like button and tell me, did your broker raise margin requirements on you during the crash? Type, got margin called if you experienced forced liquidation, or had buffer if your cash saved you. This has been your Hong Kong Investor's Guide to surviving the worst silver crash in 46 years. Thanks for watching, and I'll see you in the next one.